Hi, everyone. My name is Phil Blancato, and I'm CEO and President of Latimer Endowment Asset Management, Chief Market Strategist for ODIG. Welcome to another weekly Market Impact. How cool is my background, by the way? I stole that from what's an Aspen Mountain picture. I think it's Aspen, at least. And I've been out west at our annual LTAM event. It's an event we hold for many of the financial advisors we work with. It's an exciting time to reconnect with people who I'm very friendly with and I've known for a long, long time. Folks who trust me as a money manager, trust me, myself, and the team of Ladenburg. A chance to reconnect and share some ideas about what's happening in markets. More importantly, a chance to spend some fun time together too. We do get to know each other and spend a few minutes enjoying each other's company. So I put the background on there because I got to ski for a few days. You can see I'm a little tan. Goofy story. I got invited to a restaurant at the top of the mountain of Aspen. Really kind of cool, the Mountain Club. It's kind of an exclusive place. I'm not a member, so someone invited me. So it was kind of fun to go there. Was this opportunity to just be in a place that was unique and different. Well, you walk in and you take your stuff off and you take your boots off and you actually, they even give you sandals, slippers to wear around and you have a very fancy lunch. Not my kind of jam. I didn't grow up that way. I'm a old school tiny kid, and not the lifestyles of the rich and famous is something that I'm not accustomed to. But I was kind enough to get an invitation. So when I take off my helmet and I leave it on a rack, and the helmet, someone accidentally took it on the way out that day. So I skied the next day. I should have rented a helmet. It was kind of silly of me not. But I skied for a full day without a helmet on. Put some suntan lotion on, but it was so sunny. I am brown, burnt. I got a lot of sun in one day's time out in Aspen, Colorado. It's beautiful here. Never been here before. Actually, I shouldn't say that. I think as a kid, I was 19, 20. I came out skiing one time. My ski career is kind of funny. I skied a lot as a kid. Took about 15 years off when my daughters were born, who are now both excellent skiers. And then once they started skiing, got older, I started skiing with them. So I took a long time in between, and now my love of skiing is back. So I enjoyed being out here in Aspen. Not the best snow year, but hats off to a beautiful little area. It's got its bougie, don't get me wrong. Some of the people and the way they dress and act around here are quite hilarious. Again, I didn't grow up that way. To each his own. Certainly was impressed with the town of Aspen is quite beautiful. The restaurants and the location, Snowmass, another wonderful mountain that's here, part of the four chains of mountain. Highlands, also another very nice. So really cool place to be. So if you're looking for a ski vacation where folks can do other things besides skiing, I recommend it highly. I think it's a nice place to come to. Luca did come out at the tail end of her spring break. She came out, which I thought was fun to see her as well. Anyway, hoping you had a wonderful week. Hope you enjoyed the NCAA tournament. Georgia got knocked out in the first round. I was going to go to one of the rounds. I was able to get my hands on tickets if they advanced. They did not, so that's okay. They had a good year, good enough for them to hopefully keep their tradition of Georgia basketball going. Certainly some fun teams in the final, and we'll see who wins this thing. It's fun time of year to watch some basketball. Everything else is kind of boring right now. We're on the post World Baseball Classic. I was really excited for the Italians. They didn't make it through. Cool for Venezuela, a little country like that winning the World Baseball Classic. I think it's awesome. It's so fun. Big. Sometimes you just can't make it up. It's like a storybook thing. Obviously, the United States involved with Venezuela and the capture of their president, and then Venezuela beats the United States in the World Baseball Classic. The little guy beat the big guy. It's almost like it's scripted. Not going there, but it sure does feel like it's scripted. Anyway, to start the day, you can't avoid the headline right now. And the headline is that as of now, markets are ripping significantly higher. And the reason why clearly is that there's hope of a ceasefire between the United States and Iran. And it doesn't seem like the Iranian officials, if we know who they even are these days, who is the Iranian officials right now. It seems a little bit, a little hard to understand. But the president did postpone strikes on the Iranian infrastructure. He went out of his way. They're having active negotiations with them, and that it is still regime change, and they are no longer willing to pursue nuclear power. Interestingly, I saw they did launch 2 mid-range ballistic missiles that could go as far as 2,500 miles, which is quite fascinating because that means they could reach Europe. Now, the missiles ended up not being anything of significance, but Iran's still showing some strength. They've been decimated for the most part. And maybe that's why they're at the bargaining table, if they're at the bargaining table. It seems the president seemed to say that was the case, and they're moving closer to a deal. Why is that relevant? Because the stock market is ripping higher. As of right now, The S&P 500 is up 2%. The Nasdaq's up 2.2%. The Russell 2000 small caps are up 2.91%. Oddly enough, the 10-year U.S. Treasury is up 4.34. I'll explain what that means in a minute. And the Dow up 2.19. Why is the 10-year U.S. Treasury up? And so I want to start there today. So we had some good data come out last week, but there's one thing that's kicking around right now, which is one of my biggest fears. My fear is not the war. Wars in and of themselves are inflationary. They tend to create a lot of productivity, things that need to be replaced. We've talked about Europe being a place where in and of itself is maybe an investing opportunity, simply because when you see what's happening in Europe, the idea of them spending on infrastructure, spending on catching up in AI, spending on defense, but more importantly, should drive European stocks for some time to come. It's having a tough year. By the way, European stocks right now on the year down 1.46%, but they were up as much as 8% at one point. So the up down, the total loss is much more than the S&P. Now the S&P is down as of Friday's close 4.68%. The Nasdaq down a whopping 6.73%. The Dow down 4.79. All of them down about 5%. Why I mention international is international taking it on the chin because it was the biggest loser. Was up the most, so down the most. Now, emerging markets haven't fared a heck of a lot better, but emerging markets are still up on the year, 4.48. You know, we're also still up on the year, small caps, depending on which side. Values-oriented small caps are up on the year, growth or not. But by and large, when you look at it net, small cap stocks are only down 1.52. A lot of numbers I'm throwing at you. Why? I want you to get the context of the markets are off because of the war, and specifically because there hasn't been a lot of understanding of what it means for energy. Ironically, the U.S. consumer is not terribly impacted by energy. I know we're all paying more at the pump. Maybe it's 50 cents, maybe it's $1, depending on where you live. Are you close to a refining outlet? Are you not? But it's significantly more painful for places like Cuba today that used to get some of their oil from Iran, and obviously with Venezuela. Certainly the Asian Pacific Rim, Malaysia, Bangladesh, which are really going to hurt, and to a degree Europe. Now, Europe doesn't get its oil from Iran, but it gets its natural gas from Qatar, which they can't send the gas through the Straits of Hormuz because the straits are mostly closed. So we're at this inflection point. And why I mention it is because the biggest thing I'm worried about, back to where I started, is the 10-year U.S. Treasury has pushed a bit higher. That's mumbo jumbo. What make that mean? Interest rates basically are going higher. Why are rates higher? You may remember just about a few weeks ago, interest rates, or how much yield you get, how much interest you get from buying a 10-year U.S. Treasury bill was below 4%, which meant mortgages was directly pegged to interest rates or to 10-year U.S. Treasury finally went below 6%. So all of a sudden, it's gone higher. Now, there's two things that have happened in the war which are quite interesting to me. One, the U.S. dollar has strengthened. Remember last year on Liberation Day, the dollar sold off, international stocks went higher. Well, the dollar strengthened. Why is that so important? Simply because when the dollar shows strength, what's old is new again. The U.S. economy is the biggest in the world, but people flight to get a flight to safety in the middle of a war, and they want to hide out. So they hide out in the dollar. Guess where they're not hiding out? Gold. Gold getting knocked around pretty bad. Depending on when you bought it, the tie. Believe it or not, gold trading way down at around $4,500 an ounce. Why? Because gold is a crowded trade. There's so many people that piled into this gold euphoria that the United States economy was going to go into the way of the dodo, when the reality is the Stella America trade has become irrelevant. There is 9 days this year where both the dollar, U.S. bonds, and U.S. stocks all sold off. That's nothing. The bulk of the world is still investing in the United States. Back to where I said I was going to start today, and I still haven't given you the answer to the equation here. What I am worried about is why is the 10-year U.S. Treasury going higher? That's an important one. I get that people are buying the dollar right now because it's a safety. I get they're selling those stocks. We're worried about the price of oil, what it might do to the U.S. consumer. But remember, we're not using, here's the counterbalance. It's spring. We had the first day of spring, everybody. Hopefully you did something fun. I don't know if it's true, but I used to bounce an egg on its points. I think you can do it any day of the year, but back in the day, they used to stay on the spring solstice. The equilibrium because the sun is directly over the equator. I think I might get that wrong. You can bounce an egg on its points, but anyway, sorry, I got distracted. My point is, when you think about the dollar, it's become a safe haven. Stocks are sold off because of the price of oil, what it might do to the consumer. The consumer, I don't think, is going to be hurt very bad because of higher gas prices, because we are not yet in driving season. We're not yet in cooling season. If you're on the East Coast, you might still be heating a little bit. We still continue to be struggling with weather. My friend lives up in Maine, Lena Jo Hartley and Darren Hartley, dear friends of mine. And they just got another 6 inches of snow in Maine. I might go skiing again in Vermont because it's better snow in Vermont than it is here in Aspen, Colorado. That picture behind me, I wish it looked like that. It's pretty brown out here. We're going to have a tough fire season. So when you think about the consumer, I don't think the consumer is being punished yet because of higher gas prices. A prolonged period, let it go well into the summer, where we see elevated natural gas prices, and we did not yet. Natural gas in the United States, something that consumers are reliant upon, has hardly moved because we produce our own gas. We're not affected by Iran. Much more for Europe, and much more for Asia. But the price of gasoline is higher. But at the time when you're not cooling your home, you're not heating your home, you're not driving, not a big deal. If this goes on for a prolonged period of time, 3, 4, 5 months, different ballgame. And that's just not where we are. We're in the middle of a scenario where I find it quite fascinating that the S&P, for all the worry about oil, is only down, was before today, 4.68%. And the modicum of good news, remember, don't manage your investments based on ups and downs of headlines, geopolitics. If the facts change, then fine. Let's make sure that if the facts change, we change. I can rethink my strategy if the facts change. But factually, not much has changed except for those interest rates. So back to all that. Why are interest rates going higher? Interest rates should be going lower. And the reason why they should be going lower is because people pile into the bond market, buy more bonds, which means bond prices go higher and interest rates go lower. The opposite's happening. I think it's because of what happened, one, with tariffs, that we're going to get less tariff revenue for a while. 2, the cost of the war, a couple $100 billion already. And 3, that the world is awash in debt. So where's the money going? To short bonds that mature in a year or two. Why? Because the yields are good enough. You don't have to take the risk of owning a 10-year bond, own a 1-year bond. Why is gold selling off, which should be a safe haven in the midst of a concerning geopolitical environment? Why? Because gold is way up too high. So what does it all mean? It means that sometimes the facts don't equal the market results. Factually, the U.S. economy is doing great. Not great's a big word. We had a fairly lackluster fourth quarter because of the government shutdown. Very curious how the first quarter does. I think in the midst of the war, higher energy prices, probably nothing great. But probably still a good 1.5% growth rate is what we're expecting. Earnings season, stocks, how much they've earned was great, around 12% earnings so far for the first quarter, to some degree justifying prices. Where's the pain in markets? The pain is in the AI trade. And those names have got us here over the last few years. And mostly the software trade. All those big software companies that rely on AI to become more efficient are getting gobbled up by AI. Where are we not seeing pain? In the hardware sector. There's a lot of stocks that are in the AI supply chain that are up, in some cases double digits. So what's happened is the consumer, or the investor, has gotten a bit smarter here. In fact, if you look today, I had a fun time doing some analysis over the weekend. You look what I came up with. If you look at the volatility of the market to the correlation of the market, how they move in lockstep, it's actually breaking down. Why is that a good thing? It means that some areas are real volatile and some areas are not. So as a good investor, if you're diversified, you're doing okay. Remember I mentioned earlier why I threw all those numbers at you? Was because the small cap stocks are doing fine. Emerging market stocks are doing quite well. Even the bond market, for more people buying short bonds rather than a long bond, is only down 0.5%. So you're seeing a dispersion show up, which is really quite interesting. For example, quick stat, I'm just looking to make sure I get it right. If you look at the widest performance dispersion that we've been in since 2002, a beneficiary of it is the energy sector, which is up 33%, while financials, on the other hand, are down 11%. So think about that. If you're in energy-related stocks because of the war, they're significantly higher. If you're in financials, you're down 11%. The spread between the two is 46%. That's a big difference. What does that mean? It means being diversified matters again. We've talked about this a few times. So you don't want to be just in those Mag 7 stocks who aren't very magnificent right now. You want to be in other areas of the market or where the economy is going, where things need. What do we need right now? You need energy because of what's happening overseas. You need to replace the supply chain of goods and services that gets blown up, or the missiles are right there with it. So there are other areas where money's going to be spent based on what's happened so far. And that's the key to investing. You don't let the politics dictate your investment strategy. You don't let the headlines dictate your investment strategy. And you certainly don't fall in love with the market because the market's never going to fall in love with you. Where is earnings growth? Where is spending happening? Where's the opportunity to buy things inexpensive? You've seen plenty of the buy to dip mentality just today with the market ripping higher, not yet back to even on the year. There's a great example of sometimes the headlines get in the way. What should you do as a prudent investor? You should clearly take advantage when everyone else panics. You should be a buyer. My own personal account, been buying like crazy whenever I can get my hands on a stock I like. I got to be careful because of my role. I have to make sure I pass all the bells and whistles around buying things, compliance. But certainly, I think there's a chance to buy really good names less expensively. But back to my interest rate story, where I was supposed to start this conversation, and I still haven't gotten there yet. Interest rates higher is one sign that I'm worried about. I'm not worried about the war, not worried about earnings season. The war, I think, may be coming to an end already. Already, or coming to an end. Certainly not worried about earnings season, not worried about the U.S. consumer. The latest round of unemployment data was pretty good. I'll go over that in a second. What I am worried about, why are interest rates being stubbornly higher? Why? Because there's a chance that inflation is still creeping around out there. And by that, I mean, whether it's the tariff scenario or whether it's a scenario where we're just not quite sure yet if we're out of the woods on inflation. And why is that so important? It's important because what if the Fed doesn't cut interest rates this year? In fact, what if the Fed's in a scenario where they've got to raise interest rates? Well, that would be pretty bad. And what would cause that? What would cause the Federal Reserve to raise interest rates? So it's the unthinkable, because a rate cut would be very dangerous for the markets. And why that's very dangerous? Because the bond market would get clobbered and the stock market would get clobbered. And as of right now, the latest round of inflation still sticking around. It's not quite there yet. When I look at the year-over-year change in CPI, it's unfortunately not down yet enough. We just saw the CPI data come out recently. And I looked at core services, they're still pretty expensive, up to around 3.5% to 4%. When you think about the potential of a rate cut this year, we've got a 60% chance of a rate cut. Guess what? We now have a 25% chance of a rate hike. Now, these chances are a forecasting market. I don't worry about them too much. Generally, they're not that accurate, but they spark a conversation. And the reason why, some of the data we got out last week tells you a little bit about where we're going, and I'll get right to it. Some of the data we saw last week was a little bit concerning. So, for example, when energy is higher, obviously it's going to make things a bit more expensive. Higher energy for a prolonged period of time, back to my gasoline story analogy, will cause inflation. Higher oil prices, we don't really use oil as much as we once did to heat and cool and so on. It's still in everything else, your fabrics, your oil, your changes, your car, your tires, you name it. So prolonged periods of $100 a barrel oil will cause inflation to go higher, which is why the 10-year U.S. Treasury is higher. It's a concern that this war will create a new bout of inflation. And if that's the case, then we have to have a rate hike to slow down the U.S. economy or slow down inflation. Oh boy, that is the black swan for this year. If you remember some of the conversations we've had going into it. So it's something to worry a bit about. Not a lot, but something I would be I put it in the forefront of my mind that I was disappointed to see the 10-year Treasury going higher. Now I think the war ends, oil prices come down. My expectations and everything I've been reading, every expert who's on policy, Iran just cannot keep up with the pounding that Israel and the United States are putting on it. Will we get regime change for the people who live there? I certainly hope so. We didn't go through all this to not get real change. That would be, if we have another taco moment, Trump always chickens out, which I don't like that phrase. I think he's a guy who pushes the extreme and settles in the middle. That seems to be the way it is. But hopefully there is real change for the people who live there. For the oil markets, any hint of it going down, the 10-year U.S. Treasury would reverse and start to go lower again, because this concern about higher inflation for longer would go away. All right, so I'm just yammering along here. Just some data for you last week, which supports this thesis. PPI, Producer Price Index, came in hot, 0.7 month over month, and is up 3.4 every year. PPI is the physical stuff we use to make stuff, finished products. So that was a bit of a problem. Now, you take out core PPI, which takes out food and energy prices. That's an important aspect of it, because those can be very volatile. We've talked a lot about energy already this morning. Well, then, if you look at just core unfortunately came in a bit hot as well, up 0.5% and 3.9% year over year. Now, super core, which to me is way too cute. Now we're really just kind of slicing down to nothing here. When you take out food, energy, and trade, rose 0.5, which puts us at 3.5% as well. My point is that you have this scenario where, in fact, there are hints of inflation still in there. Higher oil prices for longer would be of a great concern. Now, why I don't panic about markets is the reality is when you think about where we are from the stock market and how it's done so far, it's still all about the U.S. consumer. And is the consumer strong enough to, in fact, hold on, deal with this higher bouts of inflation? Well, the reality is, yeah, the U.S. consumer is in pretty good shape. And the reason why, when you look at spending, which is hung in there pretty well, when you look at how strong the consumer has been post-holiday season, pretty well. But then most importantly, the latest round of labor, and I don't care as much about the month-over-month job numbers. I care a bit more about the weekly data. Weekly jobless claims came in pretty well. What we saw in the weekly claims was they fell down to, get my right number here, 205,000 people per week claiming unemployment benefits. That's a pretty strong number. And why I care about that is that number to me is indicative of the strength of the labor market and where it's at today. And when I look at continuing claims, people who are looking to need benefits because they haven't found a job, that number's also been pretty strong, not exceeding the 1.9 million that I have. We're at 1.85. So that's really not a bad number, 1.85 million in continuing claims per week. What it suggests is that the U.S. consumer is hanging in there. The job market is still fairly strong and not a lot to worry about. So I guess don't let the facts, don't change your story. Don't change your outlook unless the facts change. And the only reason why the facts would change is because oil prices go higher for longer. God forbid we have some sort of terrorist attack in the United States. Or more importantly, we have a scenario where, the facts of the U.S. economy change. And it is the consumer slows down, inflation comes back in, or in fact, we're seeing just a general slowdown. What does that mean for us? Then we would change our mind. But for today, being diversified, holding a broad basket of stocks from mid, small, and large, and then most importantly, being diversified with fixed income to help weather some volatility, your portfolio is probably doing pretty well this year if that's what you're doing. That's what we've been talking a lot about. So I just think that the headlines, sure, they matter. I think they matter a lot. But at the same token, I think we have to be smart about don't throw the baby out with the bathwater. Don't let the war scare you. Don't let some of the stuff get you all worked up. We talked about muni bonds a couple of weeks back. Go out and buy some really good muni bonds, giving you a wonderful yield. And those muni bonds will make your life you'll have a lot better sleep at night moments. You don't have to worry about things when it comes to your portfolio when you have stable, solid investments in your account. All right, something fun. The world's happiest people for the 8th year in a row. Finland has taken the #1 spot of the world's happiest people on a list of countries. I thought that was pretty cool. I think the United States was down at 30. When you look at the list, it was a Gallup poll done in between 22 and 24. Respondents were asked, why they're happy and what makes them the most happy. It's kind of interesting that the folks in Finland have a shorter work week. They don't worry so much about money. There's a lot of variables that go into this, by the way. The report looks at per capita growth, social support, health life expectancy, freedom, generosity, and freedom from corruption. The United States is in the top 50, but I think we're 30th. I don't see it in front of me. And any of it. Hopefully, you're doing okay. Maybe you're enjoying some March Madness. Maybe the first day of spring, you were able to stand the egg on its side. And hopefully, you're not letting the headlines get you too worked up. I had a guy, a financial advisor, a very dear friend of mine, tell me I was absolutely out of my mind that this war was going to last months, if not years, and that was going to create economic collapse in the United States. This is a very smart economic collapse, economic destruction around the world, especially the United States. I couldn't believe the guy's comments. I mean, that's not what the facts say. Maybe he's right. I don't think that's the case. The facts, always keep it to the facts. If you keep it to the facts, generally you're going to be okay. And I think that's where we are. We're in a moment where keep it to the facts. Don't panic. Don't let the headlines disrupt you. But look at today. the market's ripping higher, could change tomorrow. I don't do that. I keep it on the long-term outlook. Earnings are good, consumers strong, and the United States, well, not the happiest country, is a pretty happy place to be. At least I think sometimes. Have a great week, everybody. I'll talk to you all soon. Thanks a lot.